Welcome to the pod, everyone. I'm David Nelson, your host. It is Friday, late afternoon. The market's closed. Wild trading week. No other way to describe it. I'm sure a lot of you at home, pretty emotional week. And I think one of these emotions on the screen, maybe it describes what you've been going through. I think it's safe to say that we're beyond denial at this point. I think most market participants understand that we've been in a pretty challenging time, not just for stocks and other asset classes, but for the economy as well. We obviously came through last week where the president announced Liberation Day, where he announced the reciprocal tariffs that he was going to put on most of the world. A lot of people questioned the formula of how that was put in place. But nevertheless, they put it in, and then markets just headed straight south. We had a down last Thursday, big down day, a follow-through on Friday, a follow-through on Monday, and then on Tuesday, a really disappointing day as what ended up being maybe up 4% at one point during the day. We gave all that back, closing in the red. The markets were driven higher in part on a rumor that President Trump was going to put a 90-day moratorium in place for most countries on the tariffs, with the exception of China. That turned out not to be true. In fact, the White House came out minutes after that and saying that it was unfounded. And stocks gave all those gains back and ended up in the red. I was actually pretty worried that night. I actually woke up in the morning and was surprised to see that futures were only down modestly. I thought for sure we were going to open up, maybe limit down in the futures. But nevertheless, they didn't. And then a very cryptic tweet from President Trump early that morning saying good time to buy. I really didn't think anything of it. Stocks were kind of waffling around. And then all of a sudden, boom, they took off because the White House did announce that they were going to put a 90-day moratorium on tariffs for any country that did not raise tariffs or come in over the top and go up against the tariffs that we have put in place. For every country that did that, with the exception of China, we actually raised tariffs on China. China came in back over the top, raised them on us. And it begs the question, what did President Trump see that forced him to make that turn? Was it just the art of the deal? Was it stock prices? Or was it maybe something a little bit more sinister? Let's dig in and find out. Welcome to The Money Runner. I'm David Nelson. Let's go through some of the charts, discuss the action this week, some of the numbers, and then let's answer the question, why did the administration make such a large change in strategy literally, hours after these tariffs went into an effect? Like I said, was it the art of the deal? Was it CEOs calling up the president saying, you could do this a better way? Or, like I said, was it something more sinister that perhaps someone in the administration got a message to the president, hence the change was made? All right. S&P 500, you're looking at it right there. You can see Liberation Day. That was from last week. I've zoomed in here. And then you saw the Thursday and Friday last week that followed. And what I've drawn here is the retracement level. And we retraced, off the lows that were set this week, off those lows, we retraced 76% of the drop from Liberation Day, the announcement. That's a pretty big retracement, and hence you're going to see some back and fill with that. And so it wasn't surprising that the following day gave back at one point about half the returns. I think we did a little bit better than that before the day ended. And then today, an outside day where we traded lower for a little while, and then we closed up on the day, putting in a pretty positive week, probably, I guess, a little over 5% for the S&P 500 from last week. That's maybe the second up week since in the last 8. Second up week in the last 8. That Wednesday day in the middle there, that giant move higher, that was one of the biggest trading days, one of the biggest up days in the last 25 years. The S&P 500 was up very close to 10%. That was a massive move. Does that mean the coast is clear? We'll see. I've got some charts that can kind of give us some perspective on that. What I don't like here is when I see the 200-day moving average that you're seeing there in yellow, when it's kind of rolling over and trending lower, it tells us that we have a lot of work to do before this call it what you want, bear market correction, whatever. We have a lot of work to do before we're going to be out of the woods here. The other thing that I don't like here is we're going to have what they call the death cross, where the 50-day moving average crosses below the 200-day moving average. That's going to happen, sometime in the next couple of days. Like I said, it was the second positive week in the last 8. This is what every trader is looking at. Everybody has this on their screen. Anybody in my business, you're looking at an S&P 500 futures chart going back over 1 month. Now you got to remember, this trades all night long. So some of this price action is occurring when you're in bed at night. All the way down there, probably between 4,800 and 4,900 in the S&P 500, we've had 1, 2, 3, 4 bottoms there that we were able to hold, and we're obviously significantly higher than that right now. That's going to be an important metric to look at in the coming weeks. All right, so like I said, what took place inside the White House that caused the administration to make a change of heart here? It was pretty clear in the last couple of days that Peter Navarro was kind of pushed aside for maybe an adult in the room, who I think is Scott Bessent. I've never been a fan of Peter Navarro. I think he swings from the hip, and I think he brings out the worst in President Trump and forces the president into going too far sometimes. Scott Bessent is well respected on Wall Street. He's the Secretary of Treasury, worked with Stan Druckenmiller, was really on the Soros team that actually broke the British pound back in the early 90s. Pretty bright guy, very well respected. And I suspect that he went to the president and said, you know what, I am seeing some things in the market that we need to talk about because the financial plumbing is starting to come unglued. We're going to talk about that in 1 second. This is what Scott Bessent saw. You're looking at the U.S. yield curve, all right, and that's that bright blue line on top is where we are today. The blue line underneath that, that's 1 week ago, not 1 month, 1 week ago. In the last 5 trading days, 20-year yields are up over 30 basis points. 10-year yields up over 20 basis points. A lot of consumer credit is priced off of 10-year yields, your credit card, your mortgage. When those things go up, it puts enormous stress on the financial system. When yields rise, it puts pressure on held-to-maturity portfolios that your local bank might have, the bonds they have in their portfolio. Think back to just a few years ago when you saw Signature and Silicon Valley banks go under, in part because their held-to-maturity portfolio was underwater. These are all things that I think Scott saw, and I think he got the message to the president. At least that's my positioning on it. Some other things I think Scott saw were that on an intraday basis, we saw 30-year yields get above 5%. That was a concern. 10-year yields broke up over 4.5%. 2-year yields were all over the place, as a lot of market participants are starting to think that the Fed is going to cut rates because of some of the economic data that we've seen in the last several days. Certainly, consumer sentiment is down. Inflation expectations, to some degree, have been rising, even though the hard data has been coming in coming in at reasonable levels. This one bothers me the most. Investment grade credit spreads. What is that? Let's say you have a 10-year bond, treasury bond priced at 4.5%. Well, an investment grade bond for a corporation for the same tenor or duration would be 121 basis points higher, or 1.2% higher. The higher that goes, the more stress there is in the system. On the left side of the page, what was a very stressful time, that was really during COVID. We're nothing like that right now, but it tells you that stresses are building up. High yield credit. These are lower quality bonds, now up to over 450 basis points above treasuries, telling you there's more stress in the system. The dollar going lower. I think maybe in the last month, one of the worst months I've seen in some time. Gold spiking to all-time highs. All of this tells us that there's stress building up in the system, and I think that's why Scott Bessent got a message to the president. What's working, what isn't, and what's next? Well, what worked this week is the same thing that's been working for the last couple of years. The Magnificent Seven. Edged out everyone else. Not surprising that large cap secular growth on a big up week like this would outpace some of the others. You look at some of these names right now, a lot of bad news already priced into these names. Now, Apple's certainly the most challenged of them all. Estimates have been coming in for really since the start of the year. Their iPhone 16 was a big disappointment. They have huge exposure to China, both on a manufacturing basis and sales basis. They're trying to move their manufacturing over to India. That will help. And there's some things they can do on the pricing level, but nevertheless, pretty challenged. But now at 27 times earnings, some people will find that attractive an entry point. Microsoft is actually looking pretty decent. Now trading at 25, 2026 numbers. And remember, they're on a June's fiscal. So that new year is going to start fairly soon now. NVIDIA, the poster child of artificial intelligence, is at 24 times earnings. That's going to get a hard look. Alphabet, it's trading under a market multiple, 17 times, even with the challenges that it's having in their AI rollout. That's a pretty attractive level. Meta trades at a market multiple. So it's not surprising in uncertain times that maybe after a big sell-off like this, people would start to give these names another look. Now, before we get all bulled up, let's understand that a bottom is not a point in time. It's not a single up day. Nobody rings the bell at the top, and nobody rings the bell at the bottom. All right, it's a process, and it's going to take them some time. I don't think we're going to feel like we're out of this until we are at another all-time high. There've been other points in history that I've experienced where we had a big move, a mammoth move in the markets. So there've been several days in the last 25 years that happened. I can remember back to the financial crisis in 2008. On October 13th, the NASDAQ was up 11.8%. That was about a month after Lehman Brothers had failed. And, of course, the real bottom wasn't for several months later at lower prices in March of 2009. I remember this one in particular. This was January 1st, 2001. The NASDAQ was up 14% in a single session. I remember that day because I had just started my hedge fund. It was my first or second day trading in the market. And by the way, it wasn't January 1, it was January 3rd. And I remember the Fed cut rates by 50 basis points. The market took off. Of course, that wasn't the bottom. It was a long way from the bottom. We had 9/11 a few months later, 9 months later. And, of course, I think the market bottomed in the following year, going all the way to October. So doesn't mean that it's a bottom. It's a single point in time. And remember, it's a process. And frankly, I don't think we're going to feel good about this until we get to another all-time high. Here's where I come out. Most of you have read my article from early this week calling for a new Bretton Woods. The first Bretton Woods was 1944, over 80 years ago. The world order in terms of trading, how it was set up, was established then. The rest of the world tariffed the United States more than we tariffed them. It made sense because we were an economic powerhouse. 80 years later, running debt and deficits as large as we are, a conversation has to take place. So if this is the art of the deal, and we're trying to get everybody to at least negotiate with us, I can applaud that effort. I don't applaud the chaos that's involved in that. We can have a financial accident if this is not done right. Execution matters. What I need to understand from the administration, what I need to understand from Scott Bessent, and what I need to understand from the president is, what does a win look like? All right. Now, if a win means that we're all going to have higher tariffs, I don't think I can go there because in the end, high tariffs on an industry protects the industry, but it makes the industry and the company inefficient because they don't have any competition. All right. If it's the art of the deal, and this is part of a larger negotiation to get everybody to lower their tariffs, because tariffs are an economic weapon, it's mutually assured destruction, then that could be a good thing. All right. If it's done properly. All right. We have a 90-day moratorium right now. So hopefully we can get some pretty good deals on that. My hope is sometime soon. I want to see it come over the tape that President Xi and President Trump are going to get together and walk us back from Armageddon. We shall see what we shall see. This is going to, probably take place over the next several days, weeks, and months. This is a process. This is not going to be a V-shaped recovery in just a handful of weeks. I think it's going to take many months to get through this. And like I said earlier, we're not going to be out of the woods until we are at another all-time high, whenever that is. All right, that's it for this week. Don't forget, if you want to learn more about yours truly, and of course the Money Runner, go to my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is the Money Runner.